this recession could be very, very serious just because we had low interest rates for so long. I mean, excessively low interest rates for so long, which means that the distortions are that much more widespread and deeper. People have got used to, I'll say zero interest rates. I mean, very few people borrowed at zero, of course, other than the big money center banks. But companies have got used to, 1% over LIBOR. They weren't paying a lot of money, and they got used to it. And if the things that they did with that money are not producing enough money, so stock buybacks, some companies borrowed money to pay dividends, but if the things that you did with the money you borrowed during those 12 years of low interest rates is not generating more revenue, you've got a problem when that debt matures and you need to roll it over.
On today's episode of the What the Finance podcast, I have the pleasure of hosting Adrian Day. He's the chairman and chief executive officer of Adrian Day Asset Management. So, Adrian, thanks for coming on the podcast today.
Well, thank you very much for asking me, Anthony.
No problem. And I'm really looking forward to talking because, let's be honest, a lot has happened this year. It's one of those years where just every single day something new seems to be happening. We've had the banking crises, we have the high inflation, debt ceiling at the moment is the big talk of the town. I guess AI as well with NVIDIA and etc. But from your perspective, what are you really watching? What are the key, I guess, drivers that you're watching at the moment?
Yeah, well, I'm based in the US. I'm from the UK, but I'm based in the US at the moment. I mean, and obviously the US is the largest market in the world at the moment and the largest economy, arguably with China, but certainly the most significant market. The things that I'm really watching most carefully are what the Federal Reserve is doing, and also other central banks, because I think that's driving. We can talk about it, but I think the U.S. economy is definitely heading into a recession sooner rather than later. How deep it is a different question. How long it is a different question. But I don't think it's going to be a sort of short, sharp V-shape by any means. So what the Fed is doing is very significant, and also the impact that is having on different sectors in the economy. Because we all know famously that monetary policy works with long and variable lags, and Milton Friedman said that, and I think everyone agrees with that. And people forget just how long those lags can be. So when the Federal Reserve started raising rates, you had an almost immediate impact on automobile sales, on used car sales, and on the housing market. But those are the most interest rate sensitive areas of the economy. There are other sectors in the economy, other areas of the economy, where those changes in interest rates, up or down, take longer to flow through. And we're beginning to see that now with the consumer. We can talk about that if you want. We're beginning to see that definitely with smaller business. Larger businesses are a little bit more protected because with the long period of low interest rates, most larger corporations were able to term out their debt and do it at low interest rates. Small businesses didn't necessarily have that luxury. So we're beginning to see the impact on small business. We're definitely seeing it on manufacturing, but we're also seeing it on the consumer, and it's going to flow through in time.
Yeah, it's really interesting. Yeah, if you want to touch on the consumer, and I guess why is that important for the US economy, and what are we currently seeing there?
Yeah, but consumer is an interesting one, actually. And I apologize to anyone who's heard me say this before in the last couple of months. But if you look at the consumer spending, just look at the headline consumer spending, you would say, well, the consumer's doing okay. The consumer's continuing to spend. And in fact, last year, consumer spending was up. And this year, consumer spending is up just a little bit. let me say why when you look under the hood, that's not quite as positive as it sounds. First of all, if you had inflation last year, if you had the prices of goods and services last year go up 8 to 10%, and consumer spending is only going up 4 to 5%, that means the consumer right there is spending less, or is buying less in terms of goods and services. They're spending more in terms of dollars, but less in terms of goods and services. And we know that. I mean, anecdotally and from corporate, from the analyst calls that the various companies put on, we know that consumers are trading down. So they're buying, store brands instead of big name brands, and people are moving. They're not shopping at Neiman Marcus now so much, but they're moving down, to Nordstrom, and from Nordstrom they're trading down to TJ Maxx and so on. So that's the first thing. The second thing, though, is this. Yes, the consumer spending is continuing and even going up in dollar terms. But what else is going up is credit card debt. So in the US, the first thing you had was the savings rate collapse. When the Fed started raising interest rates, the first thing that happened was the savings rate collapsed, and the absolute level of savings has actually gone down to below where it was before COVID. And the other thing, apart from people are continuing, consumers are continuing to spend money, but you look at the savings rate. The savings rate in the US has absolutely collapsed to like 25-year lows, and the absolute savings level in the US has also gone down dramatically. What that tells us in the last 12 months, what that tells us is that as prices went up, people want to continue feeding their family, continue sending their kids to school, but they were drawing on their savings to do it. That's logical. Now what you're seeing in the last 4 months is you're starting to see credit card balances zoom up again to 20-year highs. And now what we're seeing, not only are we seeing credit card balances high, but we're seeing credit card people defaulting on their credit card and provisions for credit card losses rising at all of the credit card companies. Capital One, which is a company over here that tends to serve the lower middle class segment. It's not like American Express or Diners, but they serve, let's say, the middle class and the lower middle class with credit cards. And that's where you would expect to find problems first, right? And there, I don't have the numbers at the top of my head, I'm sorry, but their credit card default provisions have gone up over threefold in the last 12 months. And just this year, they've gone from about 2.4 billion to 2.9 billion. So fairly significant increase. So again, when you think about it at the human level, that's all logical. Prices go up. You want to continue buying what you've always bought. You draw down on your savings a little, or you stop saving first, then you draw down on your savings second, then you increase the credit card balances third, and then fourth, you're at a brick wall. You can't pay the credit card. So as the credit card defaults go up, we're going to start seeing consumer spending go down. Not because people want to spend less, but because they have no choice.
Yeah, as you said, it's like there's a short-term effects of, home loans going up, car loans going up, and there's those longer-term effects as people do whatever they can to keep living the life they are, but it just gets to the point where they're running out of options, and then, as you said, they hit that wall, and there's a potential for this collapse in consumption. Is that what you're seeing?
I think that's where we're at, especially with the worst hit of the lower middle class, the working poor, if you like, because with the sort of absolute poor, not trying to say they have a nice life, but with the absolute poor, they're getting money and subsidies from the government, and those have continued and in some cases increased. So if you live in public housing, they don't kick you out. If you have a private mortgage, you've got to pay it, or you do get kicked out. So the working poor are the people that are hit hardest and hit first.
So do you think this will impact what the Fed does? Because I guess there's lots of talk about unemployment, and if unemployment goes up and inflation continues to come down, then there's probably more likely to pivot. What are your thoughts on that?
Well, no, I've been one of those, unlike a lot of my friends, I've been one of those that has not been in Fed's about to pivot camp. Powell and the Fed, they've made it very clear that inflation is the number one priority. I don't think they're concerned. You didn't ask me this, but I don't think they're concerned about the markets. In the past, when the stock market collapsed, the Fed under Jerome Powell in 2018, they pivoted. Stock market reacts, they pivot. I don't think the Fed is overly concerned what the market does, excuse me. And I don't think they're going to pivot in response to an economic slowdown. With regard specifically to unemployment, which is, at the front of their mind, because, the human impact is immediately seen. When you say manufacturing's down, or consumer spending's down, doesn't quite mean as much as unemployment went up. But also as part of their dual mandate in the US. They have a dual mandate, as probably everybody listening knows. And so as part of a dual mandate, but the Fed actually wants unemployment to go up. They need unemployment to go up. Now, I don't mean that Jerome Powell, Fed head, has come out and said, hey, we want unemployment's too low, we want higher, we want more people to be unemployed. Of course not. But the tightness, the low unemployment rate, they want a higher unemployment rate to reduce demand, because they want demand to come down for prices to come down. So I think they will live with a modestly higher unemployment rate. Now, I should also say on the unemployment, and this gets me into trouble sometimes, the unemployment rate, notwithstanding the fact that you could point to the unemployment rate and say that is one of the better economic statistics around right now, excuse me, and it's, the unemployment rate is staying low for longer. But, the unemployment, that's a deceptive number, the unemployment rate in the US. And if you look under the hood, you see right now that we have the highest, or reverse that, we have the lowest labor participation rate that we've ever had since they started keeping that number. That means that of the people of 25 to 55 who are in the labor pool, the labor participation rate is the number of people either working or looking for a job. If you're no longer looking for a job, right, for whatever reason, you don't count as unemployed. And so the denominator has gone down significantly. So about almost a third of the people in the labor pool are no longer looking for a job. So the denominator has gone down dramatically, meaning that the unemployment rate looks lower than it actually is. The other thing that's important is, and there's a couple, that's the most important. There's a couple of other things. There's a lot of people who were laid off from a white-collar job earning whatever it was, 80,000 a year or whatever. Now they can't find a comparable job. And what are they doing? They may be working in a McDonald's, and I'm not trying to be condescending. They're working in a McDonald's flipping hamburgers. They count as employed. They are employed, but they're not fully employed. So a lot of people work in two jobs, either a job in a restaurant plus an Uber, excuse me, and so Uber driving, for example. And so the number of jobs is a little bit deceptive in that they're not the type of jobs that people want. And I don't mean dream jobs. I mean jobs that people have had, should have, but don't have. So the unemployment rate itself is a little bit misleading.
Yeah, definitely. And that makes, as you said, they can sometimes double count people, triple count people if they have
They can
multiple
double
jobs.
count people. And the same thing actually goes when you look at the everybody talks about the large number of job openings. I don't know if it's true in the US, in the UK. I just don't know. I'm sorry, but in the US, one of the big themes is the large number of job openings. Now, there's no question that you can't find people to fill certain kinds of jobs. You go to a hotel, you go to a restaurant, you go to a doctor's office, and you just have to wait forever, not to see the doctor, but to get someone at the front desk just to talk to you. And restaurants and everything, same thing. But again, the number of jobs, so there's no question that there's a shortage of people working in those kind of jobs. And I think there's various reasons for that in the US. One reason is that they continued the COVID, whatever you want to call them, I'll call them handouts, but the COVID stimulus checks and programs, they continued that, I think, for far too long. And so those programs are only just ending in the US. So for a lot of people, if you're getting stimulus checks at home for not working, and the restaurant's only going to pay you $10 an hour anyway, you might say, why bother? But the other thing that's important about those job openings is, in what I'll call the olden days, I don't like to use that expression, but because I used to hate it when my father kept talking about the olden days. But in the olden days, you know, if I wanted to hire someone in my office in Annapolis, I would put a job in the Baltimore newspaper and the Washington newspaper, right? Today, with remote jobs, people are advertising the same job all over the place. So when those job openings are counted, they are not just double counting, but they're triple, quadruple counting the same position that's being advertised. That doesn't apply to restaurants, of course, but it applies to remote jobs.
Yeah, that makes sense. So before you were talking about that Powell and the Fed won't worry if there's a slowdown in the economy. Is that what you think will happen, or are you thinking maybe, you know, a lot of people are talking about maybe something a bit worse, maybe
No,
a
I think we're
recession?
going to see something a lot worse. But I think so. I think the Fed will accept a higher unemployment rate and a slowdown in the economy. What they will be watching most carefully is some problem in the financial sector. And we saw that with the banks in mid-March. Excuse me. We saw that with the banks in mid-March. There were 3 in the US. Everyone's forgotten about the third one, but there were 3 in the US in the space of a week that went bankrupt. And the Fed, we saw not just the Fed, but the FDIC and other agencies, but the Fed, they acted very, very quickly, and the Fed ramped up its balance sheet again. So I think the Fed, and I'm not giving them praise for acting quickly, by the way, they caused the problem in the first place, but that's a different issue. But the Fed will react very quickly and very powerfully to some stress in the financial sector, whether it's banks, whether it's insurance companies, pension funds, whatever. But they will react to that. But I don't think they'll react to a slowdown in the economy. They will react to the economy when it collapses. And I think I think this recession could be very, very serious, just because we had low interest rates for so long. I mean, excessively low interest rates for so long, which means that the distortions are that much more widespread and deeper. People have got used to, you know, I'll say zero interest rates. I mean, very few people borrowed at zero, of course, other than the big money center banks. But companies have got used to, you know, 1% over LIBOR. They weren't paying a lot of money, and they got used to it. And if the things that they did with that money are not producing enough money, so stock buybacks, some companies borrowed money to pay dividends. But if the things that you did with the money you borrowed during those 12 years of low interest rates is not generating more revenue, you've got a problem when that debt matures and you need to roll it over. That's not a brick wall, of course. That's something that's ongoing. You know, for some companies it's this year, for some companies it's not till 25, 26. But that will have an impact. So yeah, I think it's going to be a very serious recession. And when you think in particular that the lower half of the US consumer in terms of households, in terms of household net wealth and in terms of income, the lower 50% have essentially no savings at all. I mean, zero savings. So of the lower 50%, most people are living paycheck to paycheck and do not have enough savings to pay even for a $500 emergency. So, you know, when one person loses a job, a two-worker family, that's devastating because there's nothing to fall back on.
Yeah, and I think you could almost put that analogy to businesses as well. If you look at the S&P 500, there's a small minority of businesses that really produce the majority of the revenues. So if this debt crisis becomes more of an issue, and there's, you know, it's counterparty risk if banks don't want to lend to these businesses because they know they're on the edge, there's going to be this domino effect potentially.
No, absolutely, absolutely. And the banks are pulling in lending already for various reasons. Yeah, banks are restricting lending both to shore up their own balance sheets, but also because, you know, the bank regulators are leaning on them not to make bad loans. So yeah, we're going to see a lot less. We are already seeing a lot less bank lending this year than we did last year or the year before.
Yeah, definitely. It'll be interesting to see what happens with when the Treasury, when the debt ceiling gets approved, once they put all these bonds back into the market to try and raise capital again. It'll be interesting to see how that affects the bond prices and then what impact that has on, I guess, all the assets that these banks
No,
own.
absolutely. Well, at the long end, I think, I mean, a lot depends obviously on you know, what maturities the Treasury comes out with. I suspect initially they will try and borrow more at the short end, and they won't do a lot of long end bonds. That's just what I suspect. At the short end, you had short end rates in the US shoot up. By short end, I mean 1 month, 2 months, and you know, even 3 and 6 months, but particularly the 1 and 2 months shot up. And particularly recently, because people were concerned about the the debt ceiling issue. And so if you had a T-bill that was going to mature in that prime time, you know, the beginning of June, the interest rates were really quite crazy. So those rates have already come down. And I suspect that if the Treasury issues a lot at the short end, the rates won't move up a lot. But if you move out very much at all, 1 year, 3 year, you know, rates are going to have to go up because not only do you have a huge increase in supply, and that huge increase in supply is all in a short period of time, but you've also got fewer buyers. You know, China's not buying, Japan's not buying. Most what I call real foreign buyers are not buying. You get a lot of buying from the Netherlands or from Cayman Islands, but that's hedge funds, of course, it's not the Cayman Islands buying US treasuries. The US banks are not buying because, you know, the problem, as you know, what got those 3 banks into trouble, one of the things was, you know, that they had too many longer term treasuries, where when rates started to move up, the mark to market, if they mark them to market, the mark to market on those bonds went down. If they sold them, they would have to take a loss. So I think the banking sector generally is not going to be a big buyer. The Federal Reserve is not buying treasuries anymore. So the number of buyers is definitely restrained. Now, you know, I'm not saying there's no buyers, of course not. You know, insurance companies, pension funds, to them, if they can buy 10 and 20 and 30-year bonds, you know, at 4 and 5 and 6% yields, that's something that they haven't been able to do for a long time, and they're going to be buying with both fists. But that's just one sector that's buying. Most of it traditional heavy buyers of treasuries are not buying right now.
Yeah, and we've talked about, I guess, as you said, there's potential for issues with bills and bonds coming up. There's potential for a slowdown going into a bigger recession. But if we look at the markets at the moment, especially, I guess, S&P 500, NASDAQ, they're up ridiculous amounts this year. Even the past few weeks, they've gone up quite a lot. So why do you think there's this disconnect, I guess, between the real economy and the markets at the moment? And is this something that you think is going to continue? Are these investors and hedge funds, do they think that the only safe bet at the moment are the Apples, the maybe not Nvidia's, but the Microsofts, the JP Morgans, those big companies, or why do you think this performance has occurred?
No, that's a really good question, interesting question. I do think there's several factors, but one factor in the US definitely is that most of the money that is going into the market right now is coming from 401ks and so on. So even though I own my 401k, I'm not actually making the investment decision. What happens typically, and it happens at the beginning of the year, so that's why we had to move at the beginning of the year, is that employees, with 401s, they get their piece of paper that says, okay, you have a choice of 4 funds. How do you want to allocate for the next 12 months? And the 4 funds are big US stocks, small US stocks, global stocks, and bond funds. They don't have an emerging market, most of them. They don't have a choice of gold stocks or resources. So they say, what shall I invest in? Well, don't like bonds. Okay, let's buy some stocks. And so all that money flow, that is goes into the stock market. The other thing is, there's no question there's a fear of missing out. And when you see stocks like Apple or recently Tesla and Nvidia and so on going up, it just makes people want to participate in that. There's no question. But you've got a disconnect. The biggest disconnect to me is less between the stock market and the economy. The biggest disparity, shall we say, is between the wealthy, and I'm not a socialist, I don't want to sound like one, but the wealthy 1 or 10% and the bottom 50%, because the economy is really hurting the bottom 50%, and it's going to hurt them even more so. But the top 10%, they may have pulled in their spending, no question, but they've still got spare cash. And that spare cash typically has to go somewhere. Now, yes, you can get 4 or 5% on treasuries, and more money from retail investors is moving into high net worth investors is moving into treasuries. But that's still a minority of a portfolio. Most of the portfolio is still going either into real estate or into equities.
I'm assuming that you don't believe that performance will, I guess, continue for at this pace, and there'll be potentially a drop off as the recessionary tail or headwinds appear.
Yeah, I think so, and I think we run a risk of an earnings recession or an earnings market collapse, which we don't often get. Excuse me, but you can see that earnings already have slowed a little bit this year, but the analyst expectations for earnings for the rest of the year, I don't think price in much of a risk. And so there's the potential for real earnings to come down as the inflation, even if the inflation numbers don't move up, but they're not coming down. So as the impact of higher prices feeds through, as the impact of higher interest rates feeds through, and at the same time the consumer is beginning to cut back, I think we're going to see a lot of lower earnings. Does that make sense? A lot of companies reporting lower earnings, and those lower earnings are not priced into the market right now. So come the second quarter results, in July, we'll probably we run the risk, I think, of a correction in the market. And the market's not cheap. Most markets around the world are not cheap right now by any means. given, given inflation, given that last year was a rebound coming out of COVID lockdowns, so the base is high to begin with, given that interest rates have moved up so dramatically in many parts of the world, excuse me, yeah, I think stocks are doing are really quite vulnerable here.
Yes, I guess if we were to see that, then what assets would you be looking at to maybe provide that protection, or even outperform when I guess the majority of the S&P comes down? What industries or stocks would you be looking at?
Sure. Well, I mean, the first thing would be gold. I think gold is the best risk reward asset right now, and gold stocks as well as gold. I mean, if you look at the price of gold at what, 1850 or whatever it is, and you look at the gold stocks, most of the major companies, the good ones like Agnico Eagle and Barrick, they are trading at close to 20-year valuation lows. Now, if gold is trading at 1850 and your all-in sustaining cost, not your cash cost, but your all-in sustaining cost is 1200, you've got a better than 50% margin. That's not bad at all. So the companies right now, and we all complain, everyone in the mining business complains about energy going up and the cost of cyanide going up, and this is going up and that's going up. But the truth is that the margins are not the highest ever, but the margins are significantly above the 20-year average for margins in the gold mining business. So I think the environment for gold is very strong. The mining companies are in a pretty good position with robust margins, with strong balance sheets. The XAU, which is the index of leading North American gold and silver companies, is actually net cash positive right now, which for a capital intensive business is really quite astonishing. So the companies are in a very good position, and yet the stocks are trading very close to 20-year lows in terms of multiples. So I think the gold stocks are very attractive. There are some markets around the world. Obviously, anytime you look at global markets, some are less expensive than others. I think trying to play a relative valuation game can be very, very dangerous, because there's some markets that have historically always traded at lower multiples in one way or another. Like Hong Kong, for example, has always traded at higher dividend yields than, let's say, the Swiss market or the German market. So I think what's important is not to compare the Hong Kong market with Switzerland, but to compare the Hong Kong market with its own historic averages. Most of the markets that I look at that appear undervalued have one or more very significant risks. So Hong Kong is a good example. The market is very, very inexpensive right now. There's stocks, good quality companies that are trading in single-digit multiples, earnings multiples, less than book value, in some cases significantly less than book value, and yielding 6 or 7%. But there's clearly a huge risk in that market, namely the risk of China, US getting into some increase in the dispute over Taiwan. So that's a huge risk. Of all the markets in the world, frankly, and I'm looking at markets, not specific stocks, but of all of the markets in the world, I would say the UK market is actually the best value right now without having a huge overhanging risk. The market has done pretty poorly over, a lot of people say, since Brexit, but in fact that's not fair. If you go back 20 years, the market has underperformed global markets. I'm not a huge Rishi Sunak fan, and I don't want to get political hate mail, but one thing he is doing is actually trying to develop some trade agreements with foreign countries and actually try to get Brexit to work. which the last government sort of forgot about. After winning the election, they forgot that there was still a lot of work to do, it seems to me. I know COVID got in the way. So a lot of UK companies, of course, are exporters. So the lower British pound, other things being equal, is helping them. And if this government can get a few more trade deals, such as the one they just did with Japan and the other Asian countries, if they can get some trade deals done, you know, I think some of these companies will do pretty well. And in the meantime, they tend to have good balance sheets, and they tend to be quite undervalued. Again, not just relative to other markets, but also relative to Britain, you know, the UK market's own history. So that's a market we're looking at. But generally speaking, right now, I'm being bottom up, very, very selective. And, you know, we're finding stuff in all sorts of markets, Singapore, Thailand, as well as, you know, Switzerland and Germany. So we're buying, you know, disparate kinds of companies, no particular theme, but just good quality companies that are undervalued.
That's really interesting. So just looking at, as you said, bottom up, just looking at the balance sheets, I guess the business, what it's providing, what its valuation, what is its historical valuation compared to now, and then from there you would invest in it.
Yeah. Well, and one of the things I always look at is what is the biggest risk to this sector or this market, and how would this company respond in the event of that risk? So if you think, for example, the biggest risk well, to take an extreme case, the biggest risk in Hong Kong is that China invades Taiwan and the US gets involved. That's a pretty heavy risk, and you can be pretty sure that every Hong Kong stock's going to collapse. If you look at, say, Nestle, you say, what's the biggest risk to the Swiss market? Well, the biggest risk is the strength in the Swiss franc, making the exports uncompetitive. Well, then you look at a company like Nestle and say, how would Nestle react to a higher Swiss franc? And the conclusion I've drawn is that it really wouldn't be that damaging. But that's the sort of question I ask myself. How would a company that I'm looking at react to what I see as a big risk in the market?
Makes sense. And you were talking about gold stocks before, and you're saying that a lot of them, I guess, are probably undervalued compared to their historical levels. But then from your perspective of gold in general, do you think this is something that's an asset that's undervalued, or is that quite hard to?
Yeah, no, definitely. We had a huge run from the end of, well, really in March and beginning of April, you know, and in US dollar terms, it went up $250 in the space of 5 weeks. That is an extraordinary move for an asset like gold. And in my view, it moved far too fast, it moved too far, too fast on exaggerated expectations the Fed was going to and then did pivot in this March meeting with the banking bailout. And I think the market was very optimistic, very overly optimistic about that. And that's, to me, that's the reason that gold moved up quite the way it did. You know, the Fed funds futures were predicting about a 0.8% interest rate cut by the end of the year, which I think is, I'm not saying it couldn't happen, but I just think it's an aggressive forecast. And if the price of gold is based on that, then you run the risk that, you know, the cuts don't come and gold falls back. And I think that's why we're seeing gold begin to fall back, other than today, why we've seen gold begin to fall back over the last, 4 or 5 weeks, slowly at first, and then a little more seriously, because people were beginning to realize that the Fed not only had not pivoted, not only was not going to pivot, but maybe was even going to increase rates again at the June meeting. And so gold was anticipating that. But, you know, if you look beyond that, look beyond the huge amount of T-bills that are going to be issued, and the increase in interest rates is going to come from that. And look beyond perhaps one more interest rate hike in June, which will be a little bit of a surprise to the market, less now than it would have been last month. Then I think gold is very, very well positioned. I mean, eventually the Fed is going to pause. In my view, they're going to pause before they've actually killed inflation. And that's the biggest danger, and the danger that Jerome Powell is well aware of. You know, you can have interest rates moving up, and gold continues to move up because the market doesn't think that they have killed inflation. So to kill inflation, you've got to get rates meaningfully above the prevailing rate of inflation, which is what Paul Volcker did back in in 1980. People forget that under Arthur Burns, previous but one Fed chairman, who lots of people regard as one of the worst Fed chairmen in history, I think a little unfairly perhaps, but people forget that under Arthur Burns, interest rates were moving up the whole time, quarter by quarter, rates were moving up, but he never got interest rates above the rate of inflation. And that's what you need to do. So if we look at where we are right now, you know, we're going to have significantly higher rates, depending on what happens to the rate of inflation, of course, before you can say that the Fed is truly ahead of inflation. So I think the Fed's going to pause. They're going to pause before they've killed inflation. And that's the serious danger, and the danger that Powell's well aware of. At the same time, we're going to get the economy slowing. Now, if the Fed pauses, and then 2, 3, 4 months later, inflation starts to move back up, but at the same time, the economy is going into a recession, at that point, it's going to be very difficult for the Fed to resume hiking rates. So in that kind of scenario, gold will do very, very well.
Yeah, makes sense. So, Adrian, thank you so much for your time today. I really appreciate it.
You're welcome.
Yeah, I've really enjoyed our conversation. So my last question is, what is one message you'd like people to take away from our conversation?
The most important thing, I think, is not to be reactive or reactive to short-term developments in the market. It's always better. I don't mean to be stubborn, of course not, but it's always better to have some kind of well thought out plan and think in advance, how would I react if this happens? So that you're not constantly reacting to things that happen in the news. Because that's where most investors make them. We all do it, but that's where most investors make their mistakes, I think.
Yeah, and if you do that for every news event, then you're going to be changing a lot. So thanks so much for your time. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
AdrianDayAssetManagement.com. That's the website.
Perfect. I'll put that in the description below, but thanks again for your time.
Well, thank you so much. Appreciate it.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.